Welcome to Non-Consensus Investing. I'm Ram Alawalia, your host and CIO at Lumida Wealth, where we specialize in the craft of alternative investments. At Lumida, we help guide clients through the intricacies of managing wealth so they don't have to shoulder the burden alone. Through this podcast, we draw back the curtain to reveal the strategies employed by the best in the business for their clients so that you too can invest beyond the ordinary.
Hope everyone is doing well and had a good weekend. We've got an incredible week. We have an election tomorrow. We've got a Fed meeting. We're going to see 25 bips in cuts and just a lot happening out there. Highlight from my weekend is we watched Age of Adelaide. It's about a woman who doesn't age. She essentially is living forever. Essentially, she's like the female Brian Johnson. She gets struck by lightning, doesn't age. It was a great film. I've seen it before, and my almost 6-year-old son now has a crush on Blake Lively. I think it was just really hilarious talking to him this weekend. I have a video of him explaining how he wants to meet Blake Lively and make her his, he wants to marry her, buy her flower. Anyway, it's funny video. You guys should check it out. It cracks me up. So kids are really fun. Kids are really fun, especially when they get to the ages where they're getting now. They're just, you can see them develop in different ways. You look back on yourself and try to remember what you were going through. I remember my first movie star crush was Christy Brinkley in National Lampoon's Vacation. So that was clearly a consensus idea. I want to spend time today talking about non-consensus ideas, but I thought it'd be fun to open it up there. So for those that don't know, Chevy Chase was like a superstar in the 80s and 90s, and he made these movies, and this is one of them. There you have it. So I want to talk about a few topics. I mentioned a few of these in the newsletter this week, and I do think it's a pretty pivotal week ahead. So it's worth spending some time together to unpack some of this. There's a lot happening. I did spend last week in Vegas at Money 2020 as at the FinTech conference. I got a chance to meet with one of our clients. He's a music producer in Vegas, and he's got this badass Cybertruck with the black wrap around it. I won't walk you through that, but he introduced me to the concept of panic mode. Panic mode is when you got to engage with the steering wheel and make some maneuvers here. It's really not my kind of vehicle. He called it like an alpha bro vehicle. I think that kind of makes sense. Like the vibe you have to want to drive in that car, it's definitely not for me. One of the other things we did in Vegas was check out the Tears for Fears concert. That was super cool. So they're the guys that made the song Everyone Wants to Rule the World, and also Shout. In my mind, 80s synth pop is the height and the golden age of Vol music. That was a lot of fun. I haven't been to a concert in a long time, so it was really cool to do that. A few things. I'm going to talk about election impacts in a bit, but I would say if you look back to my last broadcast, it was October 17th. The point I made there is that I think we have peak Trump bump. And since then, you've seen financials and other categories sell off, including small caps. So I think that was an accurate call. You're seeing the price of Bitcoin drop from $72,000, where it was not too long ago. According to some of the polling and the betting markets like Polymarket, the election is getting more competitive. At least that's what those polls and election markets are saying. I'm not an expert in calling elections by any stretch. I'm not going to try to do that. The more interesting question is, how do you position in the presence of uncertainty, which is where I'll focus my time here. So some of the main things I think worth calling out on the macro side, we have this Fed meeting coming up. It's going to happen. Then we'll see 25 bips in cuts. That's priced into CME, Fed Fund futures markets. The Fed doesn't like to surprise markets this close. On October 17th, in that video, what I shared was that the Fed had cut the short end of the curve. They cut rates, but the long end of the curve has gone up. So the bond vigilantes, people like Stan Druckenmiller, started shorting. The 10-year bond was at 3.5%. When we had our video call on the 17th, it was at 4%. Now we're at 4.3%. So this is a really interesting inflection point. What's happened since then is that rate-sensitive categories like small caps, which need to finance with debt, have lagged. They have suffered, whereas other categories that are less sensitive to rates have outperformed. If the 10-year goes higher from here, it will create a significant headwind to equities. There's something to watch. In October of 23, equity markets bottomed the same day that the 10-year topped out at 5%. It makes sense, right? The higher the interest rates are in the 10-year bond, you got a risk-free asset that's competing against a stream of free cash flows from equities. So if you're getting enough yield on your bonds, there's less incentive to own equities. And the discount rate you use to value equities means that the present value changes. So it also punishes growth stocks. It reinforces our thesis on this whole growth to value rotation that we're seeing, right? Value continues to do well versus growth on average. I'd keep an eye on this. My view is that the 10-year is actually topping out here and the US dollar together. Now, what's interesting is that the US dollar and the 10-year are moving together. Perhaps no surprise there. So if I go and take a look at the US dollar today, I'll type in, say, the DXY index. We'll take a look at that. That's the US dollar. So you can see the cyclical pattern here, and it appears to have topped out. Now we'll see. That seems to be the case thus far. And what you're also seeing is a rally in small caps, because if rates go down in the 10-year, that's going to help small caps. What's also happening here is you're seeing emerging markets in unison move up today, which is a change in trend, and catching and identifying those changes in trend. So here's emerging markets, ETF. You can see the last few days they've turned around. Here's Brazil. So Brazil had this projectile vomit capitulation. That's a technical term last Friday. You can see the high volume selling, large bar, right? Today it's up 2.5%. We saw that around here on August 6th. By the way, August 6th was also when we had that Japanese yen Mageddon correction carry trade news, and that led to a rally. If you look at Mexico, same thing. Friday, you had a sell-off, and now you're getting a rally, and these are near the lows. So I like this idea of a rotation to international value. See, many of these emerging market companies have corporates or sovereigns that finance in US dollar debt. So when the US dollar is higher, then their liabilities, the amount they owe, increases. They're on the wrong side of a carry trade when the US dollar value increases. That's the basic idea. Okay. Now the Fed's going to cut rates. That makes the relative value of the dollar less interesting than other currencies, holding all things being equal. So it makes sense that the dollar would want to top out around here. Okay. It's also often the case that events come together and mark these changes in trajectory. We have an election tomorrow, and you have an election between two policies, one which will be more inflationary. I'd put that in kind of Trump, more animal spirits. One that'll be more deflationary. I'd put that in Harris. By the way, I'd say even that perception might not be quite correct, because if Trump does nominate Kevin Warsh to be the head of the FOMC, he will likely be more hawkish than Powell. The market isn't even thinking about that yet. So it doesn't make sense to be correct, so to speak, to focus on what the market's perceiving here. And that's how I perceive what the market is perceiving. So I think international value is a rotation that is setting up, and it might have started today, right on the dot. This is something I've been waiting for and watching very closely. So I picked up some of these international equities and indices, and we'll see how that goes. Let's take a look at some other charts I wanted to share here. This has been a market in the last 12 months have been highly thematic. By thematic, I mean that there are stories, which we call themes, that are driving the market forward. The most significant theme has been the AI theme. And last year, it was led by Microsoft. Microsoft was consensus AI. Now Microsoft's been kicked to the curb, and NVIDIA has taken the lead. Microsoft is actually now below its 200-day moving average. So the leader of the AI theme, the old leader, is no longer working. Obviously, NVIDIA is working. I think it's up 2% today. It's approaching its highs, but getting closer to its higher valuations. Semiconductors also haven't been leading, right? So you have indices that are near high, but semiconductors haven't. So NVIDIA is leading the pack in semiconductors, but other semiconductors have not kept pace. If NVIDIA was taken out of this chart, semiconductors would be far worse, okay? That's something to keep a point on. Taiwan Semiconductor, another leader in the semiconductor category, They reported earnings on October 17th, and that was the top for that stock. That was like a peak sentiment event. Okay. Everyone gets very excited. Everyone buys in. There's no one left to buy. Classic kind of phenomena. So message one, the AI theme is softer as it relates to Microsoft, Taiwan Semiconductor. It's NVIDIA, is LeBron James, and everyone else is just in a distant tier two. Okay. And that's true from an earnings growth perspective, right? What about healthcare? This is another big theme, right? We saw Novo Nordisk, we saw Eli Lilly take headlines around these miracle drugs like GLP-1s. Check out Novo Nordisk now. Look at this. This thing is cracked below the 200-day moving average, had a temporary rally here, and then really gave up the ghost. Maybe had a capitulation here. We shall see. This thing might just keep selling down. I don't know. I don't own it. We did own it last year. We sold in the springtime when it became more expensive than Microsoft by more than a few turns. And we said, gee, Microsoft's a true recurring revenue business. This is a pharmaceutical business where the IP expires inside 10 years and you've got increased competition from other players. So maybe we should get out of this. And we did. Arguably, we sold too early, but hey, made money and not have to deal with this drawdown. So that is nice. Let me show you Eli Lilly. So Eli Lilly is another name in the GLP-1 category. And the reason I highlight it is that it makes sense to focus on the leaders, right? So take a look at Eli Lilly here. Eli Lilly, after earnings, dropped significant volume. You can see that large red bar here, had a temporary bounce and has rolled over and still down today. So, I'm not going to rush in there and buy it. Look, the 4P is 36, the trailing P is 87. That's more expensive than Microsoft using my same recurring revenue analysis. Like Microsoft is 4P of 31, and even Microsoft is compressing in terms of valuation, right? So sure, I'm going to go buy that. I know apparently CNBC was talking about Eli Lilly as maybe the best buy or something like that. I don't know. I think there are better opportunities there, right? Meanwhile, NVIDIA is pressing ahead. So let's keep going. So here's another thing, defense stocks. Now, if you recall, after the tragic events of October 7th last year, you had a bottom in defense stocks, and it's been off to the races ever since then. An incredible run. And what's happened here? You've got to break through these moving averages. What that means is there are more sellers than buyers. That's it, right? So let's take a look at, say, Raytheon. You can pick up kind of any one of these, Lockheed Martin, etc. And I'll share my screen here, and look at that. Yeah, that's not something I'm excited to participate in. How about Lockheed Martin? Same story, right? And where does it go from here? To the 200-day settle somewhat here? We don't know. But the higher level idea is that we've had a thematic market and we're seeing breakdowns in these various themes, okay? What about home builders? So home builders, now we pointed out this in our newsletter 3 weeks ago. We said, gee, mortgage rates are really high and home builders haven't cracked. The day after that home builders cracked is really funny. We actually held on to our home builders because we don't want to pay taxes. So what do? You launch an ETF so you can do in-kind transaction. The IRS does not recognize in-kind transactions as capital gains. That's what you do. That's the answer to this problem. So we wore the drawdown. By the way, quick plug, go to lumidaetf.com and fill out this form. If I can get to 500 names here, then we can do some discovery and figure out the right product to launch here. There's a lot of interesting things in the ETF space to consider. I'm excited about that idea. I think in an age where you got this hot ball of liquidity and you got to be more nimble, just given the hand that Mr. Market is playing, I think having an ETF could be quite compelling. So here's home builders. They sold off when mortgage rates topped out. I actually do think they have bottomed. We actually added to our home builder, My Homes, MHO, last week ahead of earnings. That did well. I think it's up today. And here's MHO. It's up 4% today. Yeah, it's doing well. I think it's outperforming the other home builders because it's cheaper. It's got a 4P of 7.8. And they got free cash flow and buybacks. It's my only home builder. Try to find the best leaders in the category and try to pick them well if we can. If we think the entire theme is on sale and you can't really pick the winner, then I'll try to own several. And that's what we're doing with healthcare. And I'll come back to healthcare, right? I don't see mortgage rates going much higher than here. They would go higher if the 10-year went higher. It really turns on the view on the 10-year. If the 10-year goes higher, then home builders will be in a world of pain also, is my speculation, okay? So here's the real estate index, right? Now this is dominated by DLR, which is like a data center play. They rent space out to CoreWeave. That chart doesn't look pretty either, right? It just broke support. So this is the bigger theme. You have a thematic market where the themes are breaking down. There it is. So it's trying to bounce here. Okay, we'll see what it does. I doubt it gets through the first time there, but I don't see anyone talking about this, by the way, right? It's a thematic market and the themes are breaking down. How about the momentum ETFs like MTUM? MTUM actually, it's not quite a momentum index. It does have stocks that are defined as having a lot of momentum, but it actually owns a lot of quality businesses. In fact, from time to time, I've owned a number of these names. It's got NVIDIA, JP Morgan, Broadcom. Okay. Yep. I've owned those names or own them, right? There's Costco, don't own it, too expensive, a quality business. There's Coke, there's Defense, there's Progressive, there's Intuitive. These are world-class businesses, but they've gotten expensive. And world-class businesses are rolling over also, right? You talked about, there it is. Look at that. From 208 to 202, just a lot of red days. That's really the last 2 weeks. Remember October 17th, that last webcast, that really was the top. And again, I think the 10-year had a role to play in that. So maybe we get a bounce around here if the 10-year does settle. We shall see. So while we're here, by the way, I got to take a look at Kava. What the hell's going on now? Look at this thing just keep going up. This thing's got a 285 forward PE ratio. This thing is, if everyone that bought like a chopped salad at Kava had instead taken that $16 and bought a fractional share of Kava, they'd be up, what, like 300% in the last year? So this is momentum. This is the momentum factor. And the point here is that it's softening. It's weakening. You can see it. Even Kava, even though it's up a bit today, it's softening, right? That's the broader point. And mean reversion is starting to present itself, okay, from a factor perspective. Here's an ETF showing the most popular stocks. It's actually an ETF issued by SoFi. They take a look at what their clients own, and I assume their clients probably don't know what they're doing. Yeah, this one has broken down as well, right? Or it's breaking down. It's below that. So I pull up the chart here. There you go. Popular stocks aren't performing that well. These are stocks indexed to, call it, animal spirits, what people are talking about. You can see that, of course, in, say, Robinhood, it's a very popular Twitter stock. They reported earnings. Now they're bouncing here. We'll see what happens. I don't really have a view on it. It's not the kind of thing I would want to own. It's very pro-cyclical and it's very popular. It's just not the kind of thing I would ever want to explore. So let's get back here to this. Now, what about utilities? Look at this. Now, utilities are part of the data center theme, right? The data center theme touches semiconductors. It also touches utilities. It touches the hyperscalers, such as Google and Microsoft, because they have the cloud. It touches Meta because they have the app layer. So utilities are down also. So, it was announced over the weekend that the US regulators denied Talon Energy from executing an agreement with Amazon. Amazon was going to get a lot of nuclear power to power a data center in Pennsylvania. We used to be long Talon Energy, by the way. In my newsletter, I wrote, you should sell Talon. So we had a buy call on Talon back in February, which was somewhere around here in our newsletter. You can go fact check me by going to Lumida Ledger. It was somewhere in the 50s and 60s. But yeah, so utilities we sold out of, we owned VST. Let me take a look at VST, Vistra Corp. And yeah, that black arrow is when we sold. We waited for the big red bar, just waited for the red shoulder. We say, hey, look, there's a parabola here. Stay on it up until you get the right shoulder, then get out, pay your dues and just get out. And that's what we did. That seems to have worked well. I think utilities are going to face continued weakness. By the way, this is the pattern of the hot ball of liquidity, which I've talked about in the last webcast, talked about it many times now. You see it in China, right? You see the rally in China. The hot ball liquidity shows up and the hot ball liquidity goes away. Here it is. There's a parabola. Hot ball liquidity goes away. So, if you're aware of it, I think you can improve your performance. And it also brings to mind the question of what's the point of strategic asset allocation if you do it annually when the markets are more dynamic than that, right? So the vast majority of wealth management is done annually. So at year end in December, you're going to have Goldman Sachs, Morgan Stanley, JP Morgan, they're all going to have this strategic asset allocation grid that specifies the weights to own for every category. and they revisit next year at the same time, I already front run them in a certain way, right? I sold the utilities. They're going to figure out that they should sell utilities a month from now. Shouldn't asset allocation be more dynamic? That's a leading question, rhetorical. I say, of course it should be. So a lot of the way investment management and wealth management is done today doesn't really make much sense. That's one example. By the way, another example is this. The way people construct portfolios, they use these correlation matrices. They build what's called a covariance matrix, which is based on historical returns. And they figure out what stocks zig when others zags and try to put them together to minimize the covariance or the volatility of the portfolio. The problem is those correlations can change when there's a policy action. For example, we have an event where the Fed's going to cut rates, and if international value stocks are rallying now, then the correlation of international value stocks to the rest of your portfolio just changed starting today. Okay. Remember when the vaccines came out in COVID, that was the exact top in Peloton and Zoom stock. That's another really good example. It's an event in time. Here it is. This is Peloton, somewhere around Jan 21. Okay. Let's take a look at Zoom. How funny, by the way, that Zoom is rallying as soon as Cathie Wood sold Zoom. This is around October 20th, right? Jan 21. There you go, around Jan 21 too. You can have these events that just change the market regime, and it's going to take too long to show up in the correlation because these correlations take at least a year's worth of data, if not 6 months at the very least, to update. So meanwhile, the markets change and you're waiting for your factor model to update. That's the flaw with those approaches. Now, there's value in those approaches too, but that is the flaw in those approaches. So let's get back here. Yep, that's not going to help energy stocks. It's not going to help utility stocks, especially the independent power producers, including Constellation Energy, who is working out this deal with Microsoft and 3 Mile Island. That's down 11%. So yeah, big volume spike. We'll see what happens. Too early to get in the water. Hopefully you're not in the water. Right? If you followed us, you're not in the water. Okay. So the bigger message is there's a pattern of overcrowded themes retreating. You've got overcrowdedness in certain themes. Now, what does it mean when you have a theme that's overcrowded? What does that even mean? Because every buyer, there's a seller. All stocks are held in aggregate. How can something be overowned? Really has to do with the composition of the ownership. It has to do with who owns it and the quality of that investor and the staying power of that investor. Do they have diamond hands? Do they know the asset or not? So what happens at the top is that you get momentum chasers and people that don't know the asset that well. They own it and they are quick to run. Classic example. Remember on CNBC, the guy who bought Upstart and they said, "Hey, what does Upstart do?" And he says, "Sorry, there's a connection issue here. I don't know what you're saying." You remember that guy? Who is that anyway? Can we look up that firm? Upstart, CNBC guy, confused. Let me Google that. What does Upstart do? Let me pull up this video for you. What a classic, right?
Money in right now include Upstart. That is one.
So, well, Upstart's up about 25% just in 4 days. That's a good-looking name, very powerful, very strong earnings. These stocks are.
What do they do?
Really
I don't even know them. What do they do?
Excuse me?
What does Upstart do?
Sorry.
What kind of company is it?
Yeah, I'm not. You're breaking up.
Who is this guy? Someone please message me who this guy is. How funny is that, right? Okay, look, that's what happens at tops of markets, by the way. And it also happens at a top of security. You have weak-handed people that are looking at a chart, they're doing momentum breakouts, and like, oh, okay. What did he say? It's like a nice looking chart or something like this. What kind of analysis is that? Technical analysis is the last step, not the first step. Okay. There's a role, but it's the last step, not the first step. Now, what's the smart money doing here? The smart money, that's like Warren Buffett, right? So slashes Apple. I agree. I would be slashing Apple too. The earnings growth is low relative to the valuation. He's also selling Bank of America. I'd be doing that too. They've got a bunch of unrealized losses in the portfolio. They'll be fine, but the business isn't as worth as other businesses, right? So, the other thing about Buffett is that investing is social. Investing is a social process. You can see that on Twitter. Remember when rates topped out in last year, Bill Ackman published a tweet saying rates, this is the top in rates. And that was the top in rates. Just became an event. The mere publishing of that created an event. And people were waiting and coalesced around that. People were waiting for rates to top out. They just needed a match to create a shared knowledge, the shared perception that we all agree that it's the top in rates. I'll tell you a funny story about the Berlin Wall to make it all come together. So the week before the Berlin Wall fell, if you were trying to cross the border, you'd get shot. Okay. And a week later, there were roses in these rifles. What happened is it's called the problem of private knowledge versus shared knowledge. So privately speaking, everyone in that border wall knew this regime wasn't going to go down, or it didn't make any sense, right? But no one knew they could share that with anyone else for fear of being shot, especially the border guards. Then there was an event that changed that, where person A and person B realized that the shared common perception. And then the guns went down, the wall went down, and that's it. So that phenomena also happens here. You have a guy like Warren Buffett, people follow the leader. And there are a lot of people that follow Warren Buffett. And by the way, the people that follow Warren Buffett have more money than the people that do the momentum trading, which are these traders that you see on Twitter. Okay. So that's something to consider here. Look at when volume increased in Berkshire Hathaway stock when the Fed announced they're cutting rates. There's a big rotation into Berkshire Hathaway. Now, usually he's a year early, but he's been doing this about 6 months or so. I'm actually more bullish than Warren Buffett, just to be clear. I'm just trying to connect a few dots here. I'll talk about why that's the case in a moment. What about sentiment? So stock price reactions on earnings are negative the last few weeks. That just suggests animal spirits have been softening, which is what we've been seeing. The growth to value rotation is still in effect. Now we go to healthcare. This is now my biggest sector. I like healthcare. Okay. We have a whole theme called Aging and longevity, right? The world is getting older. The world is graying. The demographic pyramid is inverting. And the people that vote are older. They're not going to vote away their benefits anytime soon. And guess who pays for the benefits? The US government. That's why we have a major deficit. It's because of entitlement programs like Medicare, Medicaid, Social Security. That's it, by the way. Buying away, it's entitlements. It's not education. It's not defense spending. It's just entitlements. That's it. So if you want to fix a deficit, that's how you fix it. You fix entitlements. You got to, people like me, Gen X, have to say, don't give me Social Security or cut my benefits. I'm prepared for that, by the way. I already assume I'm not relying on Social Security. So you take my benefits away. But let's all do it together, okay? So healthcare is a really interesting sector now. Look, these are world-class businesses that I haven't owned in quite a while because they've just been so expensive. Like you get what you pay for. You make your money on the buy in investing, right? You make your money on the buy. It's like when you buy real estate, you're buying a stream of free cash flows with depreciation. The lower the price, the more money you're going to make over time. The mark-to-market volatility every day doesn't really matter. Ultimately, it's that long-term stream of cash flows. So what happened is you had the leaders take it on the chin, like Eli Lilly, Novo Nordisk. We just saw those charts earlier due to increased competition. That's one. Then number two, you have Medicare Advantage. The first to go down was CVS. CVS turned out to be like the canary in the coal mine for everyone else, like Elevance and United Health. Let's take a look at some of those. So on the Medicare Advantage plans, the utilization is going up because people realize that your insurance can pay for all sorts of strange things like acupuncture or whatever else. People are taking advantage of insurance benefits. So the utilization is going higher. So the insurers are spending more. Their costs are going higher. Okay. And so all these insurance stocks got hammered. So, but then funny thing happened. You also started seeing other stocks that have nothing to do with insurance. In fact, they're the beneficiaries of insurance. Those stocks got whacked also. Now that's interesting. I pay attention when I see that. So this is DVA, DaVita, okay? It's a business that creates dialysis machines. Now, in a world of increased medical testing, doctors don't want the liability. If a patient comes in, they read Dr. Peter Attia's book and they say, can I do this test and that test? Doctor says, sure, here you go. That's why healthcare utilization is also going up. The incentives aren't aligned, right? The beneficiaries, call it like the CapEx receivers for healthcare, are medical testing providers. There are whole different subsets within here, by the way, medical devices. So why is that off? It shouldn't be off. What happened is you had a small campfire in the healthcare category with the GLP-1s and then Medicare Advantage, and then it just metastasized and the whole category just sold off. The category had a correction. That's what happened in healthcare. In the same way in the banking crisis of last year, JP Morgan sold off, even though it's a beneficiary of all the deposit inflows from the demise of these weaker banks. So you go buy the best asset, which is JP Morgan, right? Same thing's happening in healthcare is what I contend. So If you take a look at XOV, which is the healthcare ETF, it has a whole bunch of these subcategories, including pharma altogether. That's at the 200-day moving average. Not a bad point to consider getting an entry, right? It was bouncing along here and rising, and then it failed here. Actually, I went for a dip in the water there. It didn't work, so I closed my positions, right? Then said, okay, let's just wait, and now it's here. Okay. So I think healthcare is the move. These are really high quality businesses. They're not subject to the business cycle. That's the key thing. That's why they command higher multiples. Their earnings is not pro-cyclical. That's a quality business, right? DVA is a funny one, actually, because funny about this business is, by the way, the valuation is much cheaper than the S&P 500. It's up 2.5% today. I wrote this in my newsletter yesterday, by the way. I said, we have a buy call on this. So someone maybe out there is reading this or seeing what we're seeing. Largest holder, Berkshire Hathaway. Funny, huh? So there are a couple other names we like. Cigna is another one. Cigna is an insurance company I haven't owned up until like this morning. Maybe I nibbled a little bit last week. But this company is exiting their Medicare Advantage business. They're selling it out. But they're still doing insurance. They're focused on employer-based insurance companies. I'll make up a name like Google that will just self-insure their population. They're focused on more profitable segments of the market. And they also have a lot of buybacks. I like that. Let's take a look at the buybacks. Buyback 6%. Okay. Not bad. There are other businesses out there that have better buybacks, actually. But it's a quality business, right? So there's some other names I have in the newsletter. You can take a look. I think it'd be a mistake to try to find the best one because there are limits to analysis, right? These are all good businesses. They're all on sale. And so here are my other picks. Tenet Healthcare we bought last week before earnings, and healthcare service providers, that's up 4% today. We bought that right here, by the way. Bought that right here. That's a good one. Up 15% right off that. Maybe that's luck. Maybe it's, I don't know, but we got a good entry on that. Not all it works out this way, by the way. Healthcare service providers are beneficiaries of increased insurance utilization. It's just like in semiconductors. You have the CapEx payers, which have expenses going up like Microsoft, and then CapEx receivers are the beneficiaries. So the healthcare providers are receiving all those insurance payments. So if Medicare utilization is going up, these are the beneficiaries. Tenet Healthcare, HCA, one of the largest hospital chains. And look at the valuations. They're actually not that bad. 15.3, 4 PE. And how about buybacks? There you go, 5.7%. Good ROA, good ROE, right? Let's take a look at Tenet Healthcare. Price to free cash ratio 6.5 times. That's cheap. And buyback is 5.5%. The ROE is attractive. These guys can compound. These are compounders, right? These are quality compounders. What that means is they can take their net income and invest in themselves. Those are great businesses. They can just invest in themselves. What does that mean? They open up another hospital, another area, or they do an acquisition for an operation is less efficient than theirs. They cut out the overhead and admin. They layer on their customer agreements and contracts, which have better unit economics, and they make more money. So that seems like a good idea to me, right? How about UHS, United Health Services? Look at all these have a very similar kind of technical pattern, by the way. But they're not quite getting to the 200-day. People are stepping into buy, which is a characteristic of quality businesses. People are stepping into buy, right? I'll show you NVIDIA in a second where that happens. UHS, buybacks 4%, ROE 16%. Look, my analysis is deeper than what I'm showing you here. I'm just trying to illustrate a few things. By the way, here's NVIDIA. Investors don't let this stock hit the 200-day moving average. Do you see that? They step in to buy. That here, August 7th, you got here, April 18th. Other stocks, Microsoft's below the 200-day moving average, right? Look at this. This is SMH, the semiconductor index. It broke through the 200-day moving average here and here. So that's a sign of a quality stock, by the way. It means there's an institutional bid. So if there's an institutional bid, then you've got some support, which is nice. It's nice to be able to have that, right? Let's keep going. So what do I like? I like healthcare. I like energy. I like tech, but we're very selective in tech. Amazon. Let me talk about Amazon. Amazon's funny. Actually, I think I sold my Amazon this morning. I'll tell you why. We brought Amazon into the fold after I interviewed Mark Mahaney, who's an all-star analyst. I have a podcast interview with him a few months ago. You can listen to it if you're on Spotify or YouTube. Type in Lumida non-consensus investing. So he talked me into Amazon. Okay, changed my mind. Nothing wrong with that. So the thing about Amazon, though, is this. You see this $200 price? Let me put this cursor at the $200 level right there. Notice it can't break through there. You see that? So Jeff Bezos has a sell limit order at that price. It's not going to go past that price anytime soon. So my reward is $5. My risk is more than $5. So that's just a technical consideration. It looks like he sold about 25% of what he wants to sell. That'll get cleared out though. That'll eventually get cleared out. But if I don't have if I bought this, we bought this around here, by the way, around these areas. I was studying it around these green lines here. I want to pay taxes on that short-term capital gains, which is annoying. But again, if I have an ETF, I can do in-kind cash transaction, swap Amazon for another security. So long as I don't sell it for cash, I'm not creating a taxable event. And that unlocks a window of opportunities that I can take advantage of, like this. I can rotate and not pay taxes. Or I can avoid, remember NVIDIA? Check this out. This is hilarious. NVIDIA is just, okay, let me pull up SMH. You remember this is SMH. Okay. So this was the Kathy Wood top in NVIDIA, right? So when Kathy from ARK Invest bought NVIDIA, I made a post on Twitter, kind of tongue in cheek, saying Kathy Wood called the top in NVIDIA, and that was the top. I was like, what am I going to do? Sell my NVIDIA and pay taxes? No, I have to wear the drawdown. Sucks. It just sucks. I'd rather just have an ETF do in-kind transaction. So let's keep going here. All right. Financials and insurance are interesting, except election risk. Okay. So the issue with financials is this. Take a look at financials. Financials, I believe, are down today. I'm telling you, it's Mr. Mark. I read my newsletter. So why, by the way, I also topped around October 17th. That was I call it peak Trump bump day, right? So what happened is, see, Trump's policies require less regulatory capital to the banks. So they're beneficiaries. As Trump's odds are reverting to the mean, at least according to Polymark and these polls and all the rest, then people are pricing out that Trump bump somewhat, and that creates more risk for financials. So I think it's a great category, by the way. Like, I'm itching to get back into this category. There are a couple that we've already researched the category. We know we want to go buy and we want to own. We still have some exposure here and there, by the way. I think with the rate cuts and an M&A cycle that's going to start and an IPO market that's opening up, you're going to get more consolidation here. You're going to have regional banks that want to get bigger, and you're going to have lower cost deposit payouts for these regional banks, especially. I think there's a lot of things to do in financials. Let me take a look at the KRE index. So the KRE index is actually not doing too bad. I still wouldn't want to buy it here, but it's not doing too bad. People want to own these regional banks. How about like Western Alliance Bank? Remember, this one was in the headlines. Okay. It looks like there's a bid for some of these names. So I think this is an interesting category. I'm sure there are a lot of people like me thinking the same, by the way. So it's the whole Berlin Wall metaphor, right? So we have concerns on utilities, REITs, and overvalued growth. So I've been concerned about these overvalued growth stocks since forever and a day. But utilities, yes, we've discussed. REITs are rate sensitive. These have actually been working today. One day does not make a trend, but I think real estate, it does seem to me that this category is probably topped out here. It's not dissimilar from utilities. And I think the reason it's got a bump today is because of hope that the 10 year is declining. Now, it's worthwhile looking at the top holdings here. Prologis and Equinix. Prologis down 7%. Data center play. This business has got a 41 Ford PE. Like, the leader's rolled over, right? The leader has rolled over. That's not a good sign for this category. What about Equinix? 70 times Ford PE. What the heck? NVIDIA is much cheaper than this. And these are REITs. Wait, actually, this one is not a REIT. I got to check on this one. The REITs have to pay out 90% of their income. But look at that. Look at that. This is a classic top, by the way. You see this buyer exhaustion right there and that hard sell. This is not a good picture in my book. They've been wrong. I don't know, but I'm not excited about REITs, right? Consumer is good. Visa, year-over-year card spend is good. You know, I wrote about Visa a few months ago when it hit the 200-day. Take a look at it now. Visa with the 200-day, boom. This is when we wrote about it. It had a little fake out here, scared some people. Now it's back to, is that all-time highs? All-time highs. Quality business. Yeah, I probably fully priced. I don't know, hard to say. 26 Ford PE. It's expensive. I think other things I own are cheaper, but that's what you get with the quality business. You have to pay up. What else? This is an interesting chart. I saw this over the weekend. US stocks are taking over the world, the market cap of US stocks. This goes back to the earlier point I made around international value. If you're going to have a rotation, usually wouldn't it be ironic if it started after you see an article? Now take a look at the emerging markets. EFA, that's up. US indices are down. I think international rotation is a really interesting idea. And I'm starting to position more and more in that direction. Here's Brazil. We talked about Brazil. I want to spend time there. Here's Mexico. We talked about that. Those markets are up. Money 2020. Oh my God, the Sphere. What a joke. This business. You should not buy this stock. It doesn't mean it won't go up, because in Q4, a lot of stupid things will happen. They're losing $200 million a year, and their game plan is to build more Sphere. So how do you make money? How do you bail yourself out with growth if you're losing money on the business? I don't get that. I do not get that. So mortgage applications are up. That means more cash in consumers' pockets. Jobless claims are fine. Google's earnings are fine. I'm annoyed at the share-based compensation that they're taking. It's way too high, but it's the cheapest stock in the Max 7, and the earnings growth is fine. Google Cloud is strong, more than fine, actually. YouTube's a beast. Microsoft, I think they're getting a return on spend, but that CapEx spend is starting to punish them. I've been a critic of Microsoft, actually, for those that have been tracking me for a long time. Actually, I went for the dip when it hit the 200-day moving average. It worked for a few weeks and it didn't work, but I don't know. I think there are better opportunities. So a few other is coming up soon. I tried to dress up as a Balrog from Mount Doom for Halloween. I was not able to figure that out. Let's shift gears. I had a few other topics and we can call it a wrap. I have a podcast interview with Michael Green's a fund manager. He's worked for Peter Thiel in the Clarion Fund. That's going to come up very soon. We're going to have an interesting conversation on, is passive investing dead? I think is passive investing killing active investing? I think the answer is no. I think I've shown you examples, many examples today, about active investing is alive and well. Sell utilities, be careful financials, look at small caps versus the 10-year, look at natural gas. We haven't talked about that, by the way. One of the themes I'm very excited about, maybe as much as healthcare, at least as much as healthcare, is natural gas. This hasn't quite repriced with the data center theme, right? Now, if you remember, back in the spring, we wrote about Shinari LNG, right? Ticker LNG. Let's pull that up here. So this is Shinari. We bought it here, right there. Wrote about there. Was it 157, 188 now? So only that name has really participated in this data center thing. But you need natural gas to power the data centers. I was listening to a podcast this weekend from BlackRock, and they're talking about uranium and natural gas. I almost had a chuckle because these guys are 6 months late to the party, but they're early in the natural gas party, actually. They're early in the natural gas part, which is good. So if BlackRock's out there talking about natural gas, more people are going to buy this. I like NVGS. It's a quality compounder with a great valuation, good earnings growth, and I think pretty decent entry too, actually. Let's take a look at this business real quick. Price free cash flow is 5, buybacks 5.3%, decent return on equity. So yeah, they run a fleet of liquefied gas carriers. And let me show you a few other quick things about the business. It's a decent trend line too, right? Oops, that's the wrong one. It's NVGS. There are a few other natural gas plays that we are researching and taking a look at. What else? A couple of questions came in here. Let me pull those up. Drop in your questions now. Yeah, Amazon's earnings. Let me take a look at my notes. We have a lot of notes on Amazon. So overall, I thought it was fine. I like the name, except for the fact that Jeff Bezos is selling at $200. So it's not going to go over there. Therefore, don't really own it right now. But Amazon has the highest free cash flow growth over the next 5 years as compared to all their names in Max 7. That's the bull case and the bear case, by the way. If they don't hit those goals, then that's the bear case, right? They got to hit those expectations. You know, they grew revenue 19% versus 17%, which was the expectation. Their EPS beat by 21%. The cloud business has ramped up due to AI, which is great. I'm going to show you this chart on Amazon. Okay, there you go. So here, if you recall in like the 22s with all the startups pulling back, there's a focus on optimizing cloud spend. So you had a reduction in spend on cloud, and those are dark days for Amazon. The stock had significant multiple compression. That's bottomed out, right? AI is back and it's driving cloud spend. Not AI is back. Cloud spend is back because of AI, I should say, right? What else? They're investing in Brazil. So they're going after Mercado Libre. Amazon's going after Mercado Libre. Now we'll see what the government does there. Mercado Libre is flat the last few weeks, but competition is the enemy of shareholder returns, right? We see that with Novo Nordisk. We see that with Eli Lilly. You see that with Hims. That's Mercado Libre. It's obviously a very popular stock. I don't know, Brazil can do well, as I noted earlier, but I'm not sure I want to own those names now. I think mean reversion is actually going to be in play now. Here's Nubank, another popular stock, a name I've owned from time to time. I'm not sure I want to own that because isn't the broader theme at work mean reversion? Momentum is fading. If momentum is fading, the mean reversion is working. So names I bought recently, by the way, FSL, it's a clean energy play. This would benefit in Harris regime. That's not why I bought it. I bought it because I think all the risk is priced in. It's priced in around here. It's up 4.5% today. The forward PE is cheap. The earnings growth is strong. Their customers are hyperscalers that need to be energy independent or carbon neutral. Nuclear is not going to come online fast enough. That's the issue. So you got to invest in solar. Mark Minaverni. Yeah, Mark is really interesting. So I've read his book. He's a classic momentum breakout guy. That strategy will work, but it only works. So what he will do is he'll find a stock that's about to have a breakout after this kind of volatility compression where essentially all the sellers have sold. And CVS is a good example of that. Or I'll pull that up real quick. And the issue with it is that it only works like 35% of the time. So if you're going to play that game, so you have a breakout here, this is like where Mark Minaverni would buy, somewhere around here, right? The issue with this is that if it doesn't work, you have to cut your losses very quickly and get out. Here's an example where it worked beautifully. Now, I don't apply this strategy, by the way. I'm just telling you how other people think about things and answering a question here, like app. So we bought app around this, definitely around here. That was great. It was on sale. And then it took off here. Look at that. So theoretically, you'd buy it around there and just hang on tight. So that's a very different kind of strategy. But most people, they don't risk manage that. So they buy it, they think it's a breakout, and then it just collapses on them. And they sit on a bunch of losses, right? So everyone probably in the uranium's doing that, but I can see it. I see like record downloads, my uranium. We did a uranium white paper 6 months ago. So all the uranium hype was there. We already had the website. We already had the page. So download it. This is the thing. Like if you're chasing the hype, you are the hot ball of liquidity. You are part of it. Okay. Let me show you uranium right now. Take a look. This is URA. Isn't this the point of non-consensus investing? This is uranium right here. Right. So yeah, look, I'm bullish. Sure. But it's a question of time frame. Right. No one's talking about natural gas right now. That's more interesting. No one's talking about healthcare right now. That's more interesting. That's where I would be focusing. What else? So I'll call it a wrap. I hope that was helpful. On the election, I would say this. If there's a Trump win, you get a bump. But I think the bump is more mute because a lot of that is priced in. Financials, we just saw, we're doing well on October 17th, right? I think if Harris is the election winner, and like I wait to figure out what that means, like who the winner is, when that's determined, as a disputer, all that stuff. I do think you'll get a pullback because the policy includes raising corporate taxes. So I think that could cause a pullback. And we saw all those themes that were declining. So those themes have one or two decisions to make. They can bounce or they can break down more, right? An obvious statement, I know, but you have an event in front of you that might govern that. However, if it breaks down, I would be a buyer because there's so much hedging that's taking place going on. I think that the risks are not that strong on the downside. I'd actually rather be a buyer, especially of things like clean energy and healthcare, actually, because the risk to healthcare is in a Republican sweep that these insurance plans on the public exchanges go away. That's an argument I read. I think that's nonsense, by the way. I don't think that's even going to happen. It's not even on the policy agenda, but that's what people are worried about. That's why I'm excited about healthcare. It's news that doesn't make any sense. Would mega cap tech perform better in Harris? I'm not as convinced. I think they actually do better in both because in a Trump regime, all the antitrust risk is lifted. Remember when after the McDonald's stunt that Trump did, which by the way, I thought was brilliant, that and the Joe Rogan, although I think the garbage truck thing just was like, no, not that. I don't know what that was about. But the first two are pretty clever, I got to say. Mega cap should do better under Trump in the sense that you're going to have antitrust lift. So Google would benefit. The CEO of Google called Donald Trump after that video from McDonald's went viral. Why do you think that is? Look, there's a subtext there. Hey, this antitrust stuff's going to go away, right? So maybe you have different performance of names in those mega cap. If Harris wins, I think mega cap will do fine. Those are world-class businesses, and indices are near their all-time highs, and those businesses are not. I think they can benefit, but I think rates have a bigger part to play in that story too. They're great businesses. Bottom line, right? Amazon, Meta, Google, Nvidia. The last three are our kind of key picks this year. They were last year too. Let's go take a look. How have they been doing year to date? Let's take a look at Mag 7. Okay, share my screen. Okay, I'm going to sort by year to date return. Nvidia, Meta, Amazon, Google. That's like the three musketeers plus a sidekick. It looks like Google's a sidekick. But yeah, those are the names we like. Been very consistent about this. Amazon, again, new to the mix, notwithstanding the $200 sell order from Jeff Bezos. And then Tesla, despite the bombing thing, is still down year to date. The thing is, people look at the headlines, like, oh, 20% pop in Tesla, I should buy. No, you should not buy. If you did that, you're losing money now. Look, this is Tesla. Okay, you had that price spike here on earnings. Okay, one more day, all the suckers buying here, and now it's down below earnings. Don't be that guy or gal, okay? Apple, Buffett is selling. We'll see if the smartphone thing, app super intelligence, whatever, AI intelligence works. I don't know. Show me, prove it. Show me the product market fit. It's a world-class business, but I don't know. I think this lag versus other names continues. Take their Mag 7. All right, we'll call it a wrap. It's going to be a spicy next couple of days. Let's see what happens tomorrow. You got one more day to pre-position ahead of election volatility. I would say that the faster we get clarity on the election, the faster the general anxiety that people have that you see in markets with an elevated VIX and an elevated put call ratio we saw on Friday. A lot of people are buying insurance. I think that diminishes. And then year-end flows enter, and then you get a nice year-end rally. So the next few days will be quite something though. So let's take a look. All right. Have a good one, folks. Make it a great week. Be well now. Cheers. Thank you for listening in on the episode. Remember, in the world of investing, the road less traveled often leads to the greatest rewards. I'm Ram Alawalia, your host and Chief Investment Officer at Lumida Wealth, where we specialize in the craft of alternative investments. Invest wisely, stay ahead of the curve, and stay non-consensus.